Welcome to the Real Estate Crowdfunding Show, syndication in the digital age at gowercrowd.com. Adam Gower, your host here today with a very unusual episode. I have two guests. Actually, I like to think of it as one guest and a co-host, actually. So in that order, my guest is Phil Anderson of Property Share Market Economics and, importantly, the author of a book called The Secret Life of Real Estate and Banking. And then my other guest / co-host is Dr. Steven Kaufman, founder and chief acceleration officer at Zeus Lending. So the short story is that I had the pleasure of meeting with Steven in Houston some months ago, and he very kindly bought me Phil Anderson's book, and Steven and I were scheduled to discuss the book on a podcast when it occurred to me that it would be a pretty decent idea to see if Phil Anderson, the author himself, would join us. And he very kindly did. So that's what you're going to be listening to today. What makes today's podcast particularly topical is the subject matter. So in short, what Phil has uncovered is that there is a 14-year of good times followed by 4 years of bad times in the commercial real estate or real estate industry that has been consistent forever. Actually, and his book gets into extreme detail. He really tracks this with considerable historical integrity from a research perspective and shows how cycles are always predictable, right? That's a big statement, isn't it? Especially today in this coronavirus madness that we're in. But the reason that today's episode is particularly important is that when I recorded it just a couple of weeks ago, and admittedly things hadn't gone quite as radical as they appear to have done over that period of time, right, that last couple of weeks, it did give me pause for considerable optimism that one, this that we're going through now is temporary. Two, that it is not a real estate driven problem or even a finance driven problem or banking driven problem. Three, that we will emerge out of it. And four, that we've still got some runway before the real estate industry or the real estate cycle comes to an end, right? So there's some big statements, but definitely worth listening to today and see if you don't agree with me. Now, before I introduce you to my guest today, I would like to note that I have put together some detailed training on how I have put together my own home office. And if you are watching this on video, you'll see that it is of TV quality. And so as you are probably working out of your own home office, I might like to put a little bit better of an impression out there to everybody that you're talking to on video conferences. I have put together a list of all the equipment that I use, together with a video that shows you exactly how I've laid it out. You really don't need to look like you are sitting in your bedroom or in your kitchen or even in your home office during these tough times when you do your video calls. Go ahead to gowercrowd.com. I've actually put a link on the homepage, a little hazardous because who the heck knows when this will all end. And I'll have to change that link. But for now, it's right there. It's called How to Set Up a TV Quality Studio for Remote Work. It is, of course, completely free. So go ahead and click on that link and get yourself set up for some professional work over the next few months, even if you are locked in at your house. All right, there's no reason to look like a schlub while you're doing it. Okay, that's it. Let's get on with the show today. It is absolutely fascinating, and hopefully it gives you the same sense of confidence and optimism as it did me 2 weeks ago. I'm very pleased now to introduce you to Phil Anderson, author of The Secret Life of Real Estate and Banking, and Dr. Steven Kaufman, founder and chief acceleration officer at Zeus Lending. Welcome, both of you. Phil Anderson, author of The Secret Life of Real Estate and Banking, which is your claim to fame for today's call, and Dr. Steven Kaufman of Zeus Crowdfunding, who, and I'm going to waft this up, was kind enough to send me with a beautiful inscription. I won't show everybody the inscription because it's not really for the general public, but who sent me a lovely inscription and sent me this book that is absolutely fascinating. And here's the background. Phil, I called Steven a couple of weeks ago and I said, do you want to do a podcast? Now would be a great time to talk about the book. And he said yes. And then I postponed it and I emailed you because we figured, have you ever seen that movie with Woody Allen? I think it's Annie Hall, where he's standing in line and there's somebody opining behind him about an author, right? Some book this fella. And he says, and he calls the author over. He says, wouldn't it be wonderful if you could ask the author for their real opinion about what's going on instead of listening to this idiot standing behind me, telling me what he thinks? Well, here we are. That scene, we've actually got the author. We would love to hear from you, Phil. If you don't mind, please start off by telling us a brief synopsis of your thesis of real estate cycles and how they intertwine with banking.
Yeah, hi Adam, hi Steve. The framework of the real estate cycle, and we're talking the American real estate cycle, is a really simple framework. 14 years up, 4 down. And the book, with that simple premise, when I was putting the book together, I thought nobody'd believe that unless I actually traced through the history. And so I demonstrate that with a very clear pattern, just going back to about 1792 with the first real banking and the first real banking and real estate panic that the United States saw on a nationwide basis. It's pretty simple.
14 up and 4 down. Stephen, I can chip in at any time you like, right?
Well, of course, we get 14 years up, 4 down, and it's punctured pretty much in the middle with what I call a mid-cycle slowdown, a pause. So it's after the recovery from the prior recession, which was 2008 to 2012, 7 years up from there, which we're at, and then you get a mid-cycle slowdown. It's just started, if you haven't noticed.
We have noticed, actually. It's very interesting.
So actually, Adam, you want Dr. Gower? Sorry. Let me ask you, Phil. Do you think I'm cutting right to the chase? So forgive me. Do you think if we're in the slowdown now that we have 7 more years?
Well, I
can't see in front of you. There might be a crystal ball on your table. I don't know if you were just rubbing it right there, looking for the answer to this question, or one of those magic 8 balls where it says yes, no, maybe not. What do you think?
No. The framework of the real estate cycle, it gives you a basic crystal ball. If you go right back to 1800, it's been roughly 14 years up, 4 down, punctured in the middle by a bit of a slowdown. The slowdown in the middle, usually some sort of, not always a recession. They can be a bit more severe than. It's not a regular type of slowdown. Some slowdowns in the past have been worse than others. But what you can say is that the slowdown which the United States is going to get over the next 12 months doesn't involve a decline in land values, or AKA today it's seen as house prices, but it isn't. It's land. Doesn't involve a decline in real estate prices. Often the central bankers have the ability mid-cycle to easily lower interest rates and a few other strategies that they can employ, which will get a recovery started. And so then you're left with the second half of the cycle, which usually runs 6 to 7 years. So we've got, after this, we should have at least a 5 to 7 year run upwards. If you have a look at, if you read the history of my book, you can see clearly that the second half of every real estate cycle is way stronger than the first. The second half of the real estate cycle is when the speculation really gets underway. It's when the most credit is created, and it's when you see the biggest boom. And all I'm saying is that if history repeats, and there's no reason why it won't, we've got a big second half coming.
So actually,
sorry, but just before we get there, in my opinion, it isn't hard to work out what's going to happen from here. There'll be, I just know the timing on it. I don't necessarily know the steps, but the world central bankers and the Fed, they can step in from here. There is a stack of room for the United States Fed to lower interest rates. That generally kickstarts things. It also means that real estate prices cannot collapse if interest rates are coming down. It'll reflate asset prices, and in about 12 months' time, perhaps 15 months' time, the world central bankers, they'll all get together and they'll congratulate themselves on having averted another steep, severe downturn, and that lays the framework for the second half of the real estate cycle. And because it hasn't involved land value, the central bankers didn't have to think much, and so they'll be able, everybody else will be able to congratulate them as well, and we'll go from there.
All right, so I have to jump in because I'm a little bit confused on the numbers. First of all, the 14.4
yes
starts at the depths of the last the depths of the last recession. Is that correct? That's where you measure it from.
Well, we have to differentiate between the two asset classes, really, real estate and the stock market. Of course, they work sort of together, but we need to, they operate a little different at both ends of the extreme, at the lows and the highs. So at taking the lows, the stock market recovers first, which it did. We had the lows in the stock market. The Nasdaq bottomed in October 2008. The Dow bottomed in March of 2009. I'm not measuring the 14 up, 4 down from there. We've got to talk about, then real estate comes in. Real estate's the last to recover. US real estate, pretty much, the figures I've seen roughly, and of course, United States is 52 states. It's states, right? It is a combination of states. I'm talking homogeneously the whole United States. You can't talk about that picture really. Every state's a little bit different. The real estate lows were around about 2012. I just add 14 years up from there as a general framework. Individual states can differ a little bit, and of course regions and towns and localities. I don't get into the fine print. We're just doing the framework. So 2012 plus 14 gives you 2026. I know some people are going to have trouble with that. It's too simple. But if you look at the history, this is what the history demonstrates. So we've got a few years left up yet.
Right, and then what you also talk about is these mid-cycle downturns, right? And that's not a real estate downturn, is it? So is that what we're hitting right now? And is that naturally triggered by this black swan event of COVID-19, or is there something else going on, do you think?
All right, now there's two things in that. The mid-cycle is usually just stock market driven. After 7 years going up and 7 years bull market, it's just time for a pause. It doesn't usually involve real estate or land values, and that's because interest rates are usually lowered fairly quickly. The second thing is on that, you mentioned what they call a black swan event. That's named, of course, for the black swans that turned up in Perth in Australia when the settlers discovered there was such a thing as a black swan. I don't think there are black swans in economics. I say that for the very simple premise that after 7 years of asset price rises and credit creation, it just so happens that if you get an event that sort of tends to come out of the blue, because we've had so much credit, it's just that the economy is on a weaker footing. If this same event had happened at the lows, it's probably not seen as so dramatic, and it's not going to turn the economy like it normally would. So I'm not a believer in black swan events. It was just time. It was time for some sort of event to take place that would turn the crowd from greed to fear. And if you have a look mid-cycle, you'll see there are always events that take place mid-cycle. You can go back to the year 2000, 2001, where you'd had a huge boom take place before that. And of course, you got the events of 9/11 that turned greed to fear. If you go back to 1981, in 1982, it was very high interest rates, and then you got Paul Volcker at the Fed having to introduce some dramatic strategies that again turned greed to fear. Adam, I can tell you, and Steve as well, this is a very regular pattern. You can see this, it goes back to 1800 in the United States. I'm staggered that other people don't see this. It really does. Really, I'm staggered.
This is amazing. I know that the phrase black swan has been used, since Nicholas Taleb, introduced it a lot. And your philosophy on the greed turns to fear, and there's just a pivot from a weak economic system that's occurring at that time. Do you think 2000 was the 2001 was that recession that you would categorize that actually as the mid-cycle correction, right?
Yes.
Okay, because that's where everyone I think gets a little bit off when they're thinking about the 14-year timeline.
Yes. Well, let me say that. Let me give you another example. I think, based on history repeating, that we'll get a fairly decent recovery after the next 12 months. We've got all the fear to go through first, but once you get to 2022 and thereabouts, a bit longer, everybody, bankers, as I mentioned before, will congratulate themselves for getting out of the recovery. By the time we get to 2026, after we've had 14 years up, very few people in the system have got any memory of the real serious land price-led recession back in 2008, 2009, and memory will just stretch back to, let's say we're 2026 looking backwards, memory will just stretch to what all the resources that people were able to combine in the lowering of interest rates and the Fed action that's going to take place over the next 6 months or so. And they'll see that having worked. So you again get into that false sense of security, and we'll get the same thing happening again in 2026 and 27 if there's a bit of a hiccup. The Fed will come out and said we've got it all under control. We'll be able to lower interest rates again. We'll be able to have this procedure, but it won't work because the next one, not this one we're in currently, but the next one will involve. We've had 14 years up. It will involve land price coming down. And if the land prices go below the value of the credit outstanding, the world then has a systemic problem. And lowering interest rates doesn't fix that problem like they discovered in 2008, 2009.
What do you think about the negative interest rates that were not present before in Japan and other countries? And you said that the U.S. has a long way to adjust, right?
Yes, it does at the moment. U.S. does.
Why do you consider long? I guess this is multiple questions, and I feel like blessed to be on this meeting with you, really. So I feel I'm a big fan. Obviously, I didn't say that before, but Adam kind of said it for me. I am a big fan, and I think you're a brilliant man. And so I really appreciate the time and the opportunity, Adam, for having me on I don't know what the heck I'm doing here, but I appreciate it. So what? My question is, why do you think we have a long way for the U.S. to drop rates? That's number one. Number two, because they can move very quickly when they can move aggressively down. And then I guess maybe because you only think it's 12 months to make the correction. I'm answering the question maybe there. But the other question is, what do you think about negative interest rates and the impact?
Yeah, that's a good question because even though I'm suggesting a reasonably simple premise of 14 years up, 4 down, the cycle, it can never repeat exactly. And clearly there are things happening today that didn't happen in 1810 and 1910 and 1950. We've got, so for example, the cycle just gone, We introduced exchange rates, and then exchange rates went floating. That sort of thing had never been, that hadn't been done before in any of the prior cycles. If we had the introduction now of, as you suggested, the possibility of interest rates going negative, and indeed some places have, that of course is a first as well. That's not been happening before. So the cycle can never repeat exactly. If it did, everybody would see it, and we'd all make our actions to develop strategies and things. So that's the first point on that. Real estate cycle going forward can never repeat exactly. There has to be stuff happen. There has to be things happen that's going to make people confused and everything else.
Yep.
The reason I mention that is because what I discovered when writing my book, and this might be a little bit hard for people to believe, and it was a bit hard for myself, but what I noticed when I was when I did all the history, and you've read the book, there's a lot of history there that demonstrates the repeats. I found that events happen in the United States that will ensure and that will definitely make the real estate cycle repeat. Now, I can't always know what that will be to make the repeat happen, and we're going to get different events take place that will be a little bit different all the time. All I know is events will take place to ensure the repeat of the cycle, and so far, in my opinion, it will happen at the right time. Yes. So let me give you an example of what I mean by that. As we went from 2010, 11, 12, and 13, we got to 2013 in the United States stock market, the Dow Jones and other indices broke into all-time new highs. Yet when it did, it was very subdued, and there was still an enormous amount of people in the United States that just simply thought the recession would go on forever, and that there'd always be another problem around the corner. We got to 2015 and then 2016, and we had market hiccups there, and all the bears came out and said this was another repeat of the Great Depression, and that we'd all have to hunker down and buy a gun and bury your cash in the backyard. And then Mr. Trump came along, a real estate guy at the top of the White House, and he spent several years trying to convince everybody that that things were on the up. That he added to it, of course, that he was creating all this stuff. We got into 2019, and I think with a few people it started to resonate. And did you notice that a good deal of greed started coming back? So that was the catalyst that put people, that simply people started forgetting about what happened in 2008 and started looking forward. And so by the time we got to 2019, just about everybody in the United States was looking forward. And of course, as I also show in my book, when you get 7 years up of the real estate market and a very big bull market, the history shows that years ended in 9. If you go back a long way, years ended in 9 usually come in as a type of peak in the stock market. All we needed was for somebody to stand up towards the end of 2019, early 2020, and give a big rah-rah and say that the business had conquered the real estate cycle, which I think Ray Dalio's offsider came out and said. And we had Mr. Trump himself come up and say it was the greatest economy on the earth that had ever been created. You're ready for a top, mid-cycle. That's the sort of thing. Things happen. I've just noticed things happen to make the cycle repeat. I don't know what those events will be, but they just seem to take place. So I'm confident, and I think if you're viewing this in 2026, and so by that stage we'll be in another big huge bull market, and we'll be ready for the top, and events will come through to see that will happen. That's just what I noticed when I was writing my book.
All right, so let me ask you a question, actually. So you brought up a few points, and I do want to get back to this question of, is it different this time, right? The 4 most dangerous words you can say. It's different this time. Is that 4? Yeah. That's actually 5. It's different this time, right? But in the sense that for the first time in history, we do actually have, correct me if I'm wrong, but in the United States, a real estate developer running the country, right? So he sees the world through this same lens in some regards. So actually, why don't we just start with that, and then I want to come back to the question of liquidity. So what do you think about that?
You go back to the first president of the United States, George Washington. He was, at the time, America's largest landowner. I mean, we've just gone talk about Back to the Future. So, you know, it's normal, I think, really. I don't see anything different from that point of view.
In terms of the way that the economy is being managed, interest rates and tax breaks and etc.
Again, I see it as the same thing. There's very little change there, especially with banking. Banking's all about the credit, and banks have to have that small margin where they're lending out money greater than what they're paying out. That process has been going on for a long time, and since certainly since 1800 in the United States, when the federal government there began selling off the real estate in large chunks, 160 acre lots really. You went to the frontier, you staked out your 160 acres, you went to the title's office to get title, then you went to the bank to get some credit. The process is not really so different today, is it? That much, and it's I show in my book, it's all based on the enclosure of the rent, so it goes from there.
Yeah, and that is the core thesis, isn't it? That it's the excess of liquidity, the connection between banking and real estate. Yes. And the cycle is the connection between is liquidity. That's what connects the dots. Can you talk about that a little bit and how that inflates and impacts the cycle?
Yes, yeah. Well, that's it in a nutshell, really. And I don't think that's changed greatly in history, and I can't see it stopping either. And we all need the credit, and I think banks they try to do a reasonable job. It's not anybody in the system that causes the system. It's just all of us acting together. Everybody tries to do the decent job that they can. So I'm not trying to lay fault or blame on anybody. It's just history just seems to show that 14 years up, 4 down, and it's just a collective action, I think.
And that's brought about by excessive liquidity, though, towards the end, right? This kind of collective.
Do you mean excessive liquidity or excessive credit?
Credit.
Excessive credit. Yes, credit. The creation of credit. Yes, and the creation is basically on the land value.
I guess I knew what he meant. I was just clarifying.
Right, but it does also refer to equity as well, right? Credit is borrowing, but as credit goes up by banks, as banks inject more into the system, people tend to pursue that with greater amounts of equity. So there is generally more liquidity. It's just more money in the economy, right? The real estate economy chasing what there is out there, and that's what creates this price inflation.
Yes, but it is, though, at its core, it's the creation of credit backed by what I would call land value, but basically a mortgage. So it's the creation of credit on the mortgage. That's the system.
Now, go ahead, Stephen.
Go ahead, Adam.
Well, I was just going to say, one of the things that you've said, I might be going off on a completely different tangent, so keep your thought there, Stephen, keep it in mind. But one of the things that you said is that each time, actually, let me phrase it this way. The last time, and I remember, in fact, we all do extremely well because we lived it, it appeared on several days during the last downturn that we were on the edge of systemic failure, right? On the very, very edge. And you've suggested in your book that each time there is a cycle, as we come to the end of the cycle, it's worse than the last time. How can it be worse the last time? I can see Stephen pausing to interject. So go ahead, Stephen, first go.
So I have a friend who's very experienced or seasoned, meaning he's very old. And when I asked him once advice about investing in the market during a recession or during a major, borderline depression recession, he said, all you have to do is remember these words, which is, it's never been this bad before. And when you hear those words, start investing, because then know everybody's so afraid that that they're not going to take any action, and that's when the opportunity will come. So to your point, I guess, Phil, Adam saying, paraphrasing what he said, I'd love to know the answer to this. How can every time it be worse than the last one?
Well, of course, I'd like to put a bit of perspective on that. It depends from whose perspective. It depends from whose point of view you're talking. For me, 2008, 2009, 2010, I can genuinely tell you, I knew that was coming. Now I know, we're sitting here in, we're sitting here in 2020, and now it's very easy in hindsight to look back. But I can genuinely tell you, after having, the book came out in 2008, I was ready for that downturn. I've often told the story. I had my cash ready to go. It wasn't. We're not talking hundreds of millions here, but we're talking a reasonable amount for an individual investor. And I was able to buy up. I had my office in both France and London at the time. Indeed, I'd already retired to France to write the book. I bought several properties in central London at that time in 2009 and 2010. They were bargains. But it was, it wasn't easy to do, but I had the strength of the book behind me. So, it depends from whose perspective you're looking at these crashes and things. If you're going to be buying, let's just assume, I know economists like to make assumptions, but if we suggest history is to repeat, 2025, say, it's not going to be a great year if you go highly leveraged in that year, and we've had 13 years up of rising real estate prices. History suggests, now I could be wrong, but history suggests that's not going to be a great year to go really highly leveraged. But some people will, and that'll create the opportunity. In the downturn after that, it'll either be the worst thing in the world that's ever happened. It'll be calamity and chaos and it's just going to be a disaster. Or you can at least try and have some sort of understanding of history, and you could do better than read my book to have a bit of an idea of what might be coming next, and try and at least reasonably position yourself for that. So I don't know. I'm a bit circumspect on whether you call these things. They're opportunities or chaos. Who knows?
So during this stage of the cycle, then, if you figure that you've got another 5 years and a little turbulence today, right? There might be some bargains just because of what's going on today. Are you an investor today? And if you are you an investor just to get in and out, before the clock strikes 2025? Or are you looking at 10-year investments, or do you wait until the market collapses before investing? What's your advice in terms of how to use this information?
Well, I don't know the circumstances of every particular investor, so it's hard for me to say I can't say what the right thing to do is. And of course, we need to differentiate between stock market and real estate and things, but we'll assume real estate. It depends on your perspective. The only thing I can say categorically from my point of view, from having written the book and having studied a lot of US history, I noticed that at the end of every cycle, the downturn wiped out people that were very highly leveraged, or people that had been trying to either gain the market or were genuine speculators as such. In other words, didn't have a lot of assets behind them. However, the real estate guys that had been genuine investors, or perhaps, again, you look at some of the richest families in the US, they had productive cash flow businesses and then put their money into real estate. Generally, those type of investors did fairly well through the downturns. The downturns didn't seem to be such a great problem. It was just the flippers and the speculators that didn't really have a historical perspective. The downturn tended to wipe them out, but a lot of other investors that had a more long-term perspective, I noticed, tended to do sometimes better out of the downturn. So it does depend on your perspective, long-term or short-term, and indeed what you're trying to achieve. It's hard for me to talk about individual specifics on that one.
Yeah, great answer though. I love your answer about that. I guess going back to the question I had earlier, I think I read this in, I don't know, in your book, Phil, and I don't want to put words in your book or in your mouth. But I thought I got the impression from the book that as we hit the mid-cycle correction, I thought it was really an equity market correction. Adam and I, communicate a little bit. It always seems like it's
yes.
And you clarified part of my assertion on today's podcast, which is amazing. But one of the things I thought I read from your book, and I might have misinterpreted this, is that the individual speculators in the market, and there are a lot of them, and I think it's even different now, the people who are in the market, and when I'm saying the market, I mean the public equities market, because of the availability and the advertising and marketing to what I'll just call the average American family or the average Joe or a non-accredited investor. The amount of families, investing in the stock market today has got to be dramatically higher than it's ever been in the past. And what I alluded from your book, I think, and I want you to correct me if I'm wrong, is that what ends up happening with a lot of those families and a lot of the speculators is they end up losing money in this mid-cycle correction. And I have lots of friends who in the last 2 to 3 weeks have lost a ton of money. They get scared, and like you said, greed turns to fear. They pull their money out, and they say they're never going to do that again because it was gambling, or they can't resist the temptation not to pull their money out because they're really concerned. Is it going to get worse? And they then look for another asset class, what's the one that never disappears in their mind, is real estate. And then they then go and put their money in real estate. Thus, over the next phase of the cycle, we'll call it the second half of the game, like you were calling it, they drive up prices because now there's all this new liquidity in the market and all this new speculation, because where else are they going to put their money? They've had this great run. Now they want to put their money somewhere else. So I may have made that up. It just seems like in my career, that's been how it's gone.
No, that's fair. I would also watch for some more repeats again as we go into the second half of the cycle. I would stay alert for technology companies turning to real estate. So it wouldn't surprise me. Well, I think it's already happening now, but you might come out of China first. Tencent and Alibaba and those sorts of companies, former real estate or former tech companies, particularly, they still are tech companies, of course. They start to get into banking. They start to get into lending money. They start to get into what usually happens, a new type of finance that comes out. So this could, I don't know how that will develop, but it could be it could be all sorts of digital coins and everything else. And as you may have picked up in the book as well, in the banking chapters, new technology comes out that allows new startups and new tech companies to take advantage of the new forms of banking. That's particularly relevant because the workers and the creators of those companies, they don't have a long history in real estate. They don't have any memory of past downturns. Indeed, the past downturn they won't have lived through because they were either too young or at university, and so they've never seen the past downturn. They'll have 14 years up of real estate. They'll think that real estate prices have never collapsed, that always go one way. You'll get the tech companies going into firstly banking, and then by default, if they ever start lending, lending funds or creating credit based on some sort of mortgage or things you've got to offer as credit as the security, you get all the setup for the second half of the cycle coming. Those type of activities, the tech companies that go into banking and other things, they bring with them a crowd of young people that they're devoted to the new technology, and that's the second half of the cycle. It just creates a lack of memory of stuff.
Would an example of that from 2008 would be the MBS? But what's an example of that? Those weren't technology companies. So would it be derivatives and the trading of those, and the sophistication of that trading? What would be an example from 2008 where a technology firm went into financial services? Or
no, it's just that you can't say that in prior cycles. It doesn't come to mind to me what the prior cycle, but there were developments if you have a look at the history chapters and with the banking, you'll see I tried to highlight the developments that happened in each particular cycle. For example, perhaps not quite directly relevant, but if you just take the city of Chicago, you know, in the 1870s, they were selling land by having people on horseback riding through the cities yelling that there was plots available. And then in the 1890s and 1900s, in that particular cycle, people that were really quick to take up the new technology, they started selling real estate by telephone, contacting people directly. And then, you know, once we got into the 1920s, it was the same thing in Chicago, except they were putting all of the real estate into bits and pieces that could then be floated on the stock exchange. So new ideas come up that allow more and more investors to take part of that cycle. So did I explain that all right? You know what I meant?
I'm just dying to jump in because I was wondering when I could get a word in about crowdfunding, and was beginning to think I don't think I can, but that is basically what's happened, particularly in the United States, is that since the last downturn, it has become legal, right, where it was not legal for developers to raise money for their deals online. So now you have this entire population of investors or you have this entire industry now using the new technology, basically online marketing, to raise money that has never been allowed before.
Well, Adam, this is really important. I am big on developers. Developers are really important. I mean, they're important to the economy, but they're really important to life in general because they build things that we all need. Yes, and their function is really important. And I don't think that developers, especially, I'm not talking speculators, developers, the people that build stuff. I don't think they're recognised well enough in society just for how important what it is that they do.
Yeah. And
so I'm not trying to highlight, we need this funding. And when you get into areas, when the banks had such a, they made some stupid decisions going into 2006 and 7 and 8. Then they get their hands burnt. They stop lending, of course, because they don't want to make the same mistakes. And then you have to have huge credit behind you and ratings and stuff to get anything from the banks. And they go overboard in the other direction where that was too loose in 2006 and 7. Then they become too tight, 2010, 11 and 12, that's the exact time when you want to be lending to developers to be building stuff. And so now, the process comes on itself. So you get some smart, intelligent people that think, well, we might start doing some crowdfunding. We might do this and we do that because developers need the money. And at the end of the day, we have to build stuff because people need to live somewhere. The population of the Earth's increasing. We need to build more things, but we need to do it better. We need to do it more efficiently. We've got lots to build, lots to create. I mean, you see that. I mean, I've been through a stack of American cities. You look at, the homelessness situation in San Francisco is a disgrace, really. And yet not a lot seems to happen. And the last group of people that's going to help you are the banks. So, it's great to see this process coming along because we need the developers building stuff. What you don't want to see, though, is when it's just building on itself and it starts to become totally mindless. And I'll leave that thought there. But all I'm trying to suggest, and what I was trying to show with my book is, it's very handy information. The history is it's very helpful, handy information to know that there is a rough guide of 14 years up, 4 down in the real estate market, and it's very helpful for developers to know.
So let's start wrapping up because, and Stephen, the two of us, we could talk to you for hours, Phil. Stephen, go ahead and ask a question and then I'll start wrapping.
I have one more. Phil, what do you think about in multifamily? And this is a particular asset class, so you may not want to speak to it, and it's okay if you don't. The fact that rents are driving, rent increases are increasing because cap rates are dropping, because interest rates are dropping, yet wages are not keeping pace with either one of those. So that you have this, you have job growth, certainly, especially in different segments of the United States. But in general, job growth under Trump, it's been pretty significant. So, but there's still this disparity in job growth. In income growth, where the average American isn't making what they were making, yet because of interest rates dropping, cap rates are dropped, so prices have gone up, which means rents have to go up, but yet it's not pacing. Any thoughts on that?
Oh gosh, Steve, there's so much I could say about that. I don't even know where to start, really. It's just so much. First, it's never been any different, has it? Wages have never kept up with either the cost of living and the cost of a house, which is why enter banks and longer term mortgages and everything else. What you do not want to be in life is a wage earner, really, because you're always going to be behind the scenes. You behind the times. You have to have other ways of income, and you have to develop stuff, and create tech, and get into the new technology. I think it's fantastic, which is what America and Americans are really, really good at, is the creation of all those new ideas and things, and that does create enormous wealth, and as you've seen over the time. But you've still got an enormous amount of people that are still just wage earners, and it's never been any different. It's never going to keep up with the way land price will go. So from that point of view, I don't see things changing much. Even though history shows as well that the cycle does warm up, and as we get longer in the cycle, more jobs do get created, and sometimes they're more high-paying jobs, and people get to take them. But we will get to a point, and I would measure that after 14 years up from 2012. We will get to a point when land price just goes so high it just cannot be afforded by the average wage earner, and that's when we hit the peak. And I don't think it's too hard I don't believe it's too hard to forecast. Got it.
Thank you, Adam, for letting me ask the last question.
The penultimate question, actually. So one last question.
Yes.
You kind of touched on this, actually dodged it a little, if I may be so bold, but I would love to have your final thoughts, if you don't mind,
Yes.
on, apart from buying your book. Oh, hang on. Sorry, that's the wrong one. Sorry, how silly of me. Apart from buying your book, what advice would you give the listeners now as far as understanding the cycle through the lens that you see it, through the analysis that you've done, and actionable steps that they can take to benefit from the insights that you've gleaned in writing this book?
Well, of course, I'm still writing. The website's at propertysharemarketeconomics.com. So, get the book and have a look at what, the website brings everything up to date in all the current stuff. I would suggest to people that they just know a little bit. I would suggest they just know a little bit of history, just enough of their own, especially in the US. Generally, I find Americans, all the people I've spoken to, they are well aware of the history, but not in 18-year cycles. So know your history in 18-year cycles. And I'd also suggest get current with the technology, and get current, with your own technology about crowdfunding and things. Understand how all that works. Understand how you can take advantage of the way things are done. That's also really important. And develop and invest wisely according to that 18.6 years. That would be my suggestions.
Dr. Steven Kaufman.
Yes, sir.
Zeus Crowdfunding. Phil Anderson, author of The Secret Life of Real Estate and Banking. Thank you both so much for being on the first podcast that I've had with two people at once. I really appreciate your time. It's been an enormous pleasure. Thank you.
Thank you.
Yeah, thanks, Adam.
Thanks for having me.
All right, that was Phil Anderson, author of The Secret Life of Real Estate and Banking, and Dr. Steven Kaufman, founder and chief acceleration officer at Zeus Lending. Well, do you feel better now? Right? Goodness, I certainly did myself when I recorded this particular episode, and that's why I am broadcasting it today for you. Hope it gives you a little confidence to see through the light and realize that maybe this is as big as it is just a bump in the road for commercial real estate. That's it. Don't forget, go to gowercrowd.com where you can get a list of all the equipment you need for a TV quality home studio for your remote working over the next few weeks, and hopefully not months, but however long it takes. It's right there on the homepage called How to Set Up a TV Quality Studio for Remote Work. Click on that link. It's totally free, of course. There's a list of everything you need, and I walk you through actually how I set up my own home office. All right, that's it. Thanks for listening, and thank you, Phil Anderson and Dr. Steven Kaufman, for your time with me today. I really appreciate you having taken time out to talk to us about these very interesting topics. That's all for this episode. I'll see you next time. Be well. And for now, this is Dr. Adam Gower signing off.